Well, good afternoon and welcome to the initial revenue estimate for the IFO that we release every year in May at this time. Let me note that the presentation will be posted at the end of this presentation along with our report. If you have any questions, I'd ask that you just submit it through the chat feature and then we can answer them at the end of the presentation. If I happen to cut off or get dropped, please just wait for about a minute and we will reestablish the connection and resume with the presentation. And with that, I will try to screen share and start the presentation. So just bear with me. And I'm going to ask somebody on my staff just to confirm that they can see that and we're all set.
Yes, I can see it.
Okay, very good. Well, thank you, Leslie. So let me also note that there's some information that will be in the presentation that is not in the report for those who are interested if you're going to go back and try to match things up in the report versus the presentation. So with that, let me begin. I think it's fair to say that the main issue for the current year is the large injection of federal monies that have occurred into the economy in response to the pandemic that we're now addressing and how those transfers will impact the economy going forward. As I'll show you, we think about $160 billion have been injected into the state economy. Most of those have now run their course. There's still some outstanding monies that will be received for unemployment compensation and child tax credits that I'll cover later. But related to these transfers and how they impact the economy and the general fund revenues, there's really four questions I'd like to cover today in our presentation. First and foremost, of course, is what happens when these federal monies are removed. Right now, they're providing support for the economy, and how will consumers respond when these monies are no longer available? I'd like to talk about a potential labor shortage and what happens when workers attempt to re-enter the labor force. We think that will happen this summer and later this fall. Inflation, you've seen that it's upticked recently. Is it transitory or is it more of a permanent feature, and how does that impact revenues? And then finally, related to this is the stock market and the housing market. You've seen very strong growth in both of these markets. Do we think there's a modest or a major correction that might occur? And what would that look like and how would it impact revenues? So we'll cover all of these topics in the presentation today. But just overall, bear in mind that there's a lot of moving parts for the revenues this year. It's more complicated than usual. So we're going to talk about the impact of the federal monies. We're going to talk about behavioral impacts. And we're also going to be talking about tax shifting. So there is a lot of moving parts, and it is more complicated than it usually is. So first, before we begin, just some assumptions that we've made in our forecast. The first assumption is that we're assuming there are no new COVID restrictions going forward. That is, there wouldn't be new variants of the virus that require mitigation efforts and business closures. We're assuming that schools will fully reopen in the fall and childcare will be available for all those who need it. Second, we're assuming that the federal programs expire as scheduled. They are scheduled to expire for the unemployment compensation in the first week of September. We've also assumed, of course, that the potential infrastructure package and any associated tax changes are not enacted, but of course that could occur this summer or fall. And finally, some other miscellaneous assumptions. As you know, there are some supply constraints in the economy. We've assumed that those will largely resolve over the summer. We've also assumed that inflation is temporary and peaks in late summer at about 4.5%, and then begins to decelerate a little. And then finally, we have assumed that there's no major correction in either the stock or the housing markets. We do have what I'd call a moderate or modest correction in both markets, but not a major correction. And I'll return to that later in the presentation. So we'll start off with the Pennsylvania economic forecasts for the main variables that drive our revenues for the general fund, motor license fund, and lottery funds. And I'll just work top to bottom on this slide. Real gross domestic product for Pennsylvania. The latest read is that it contracted by 4.4% for 2020. And then we have 3.6% growth next year. The consumer price index going up to 3.5% in 2021. And then, as I noted, decelerating to 2.7 in 2022. Net job gains for payroll employees, so this excludes independent contractors and self-employed, a contraction of 438,000 in 2020, and then a gain of 100,000 and then 80,000. Wages and salaries paid to all payroll employees, it was roughly flat for 2020. And then we have strong growth in 2021 of 6.7 and then 4.3. And then finally, the Pennsylvania home price index, 7.4% and then 11.9% for the first quarter of 2021. And just a note about this final variable, the home price index, these aren't homes that are necessarily sold. These are homes, all homes, and the increase in the existing value of the home. So it's not just a measure of homes that were sold, it's a measure of the value of all homes across the state. On the next slide, we look at the same variables, but we look at some recent quarterly growth rates, and most of these are year over year, except for the first one, real GDP, which is a quarterly annualized growth rate. And going from top to bottom, you can see the contraction in real GDP in the second quarter of 34%, and then most of that is reversed in the third quarter, and then moderate growth for the fourth quarter of 3.7. There's a lag with the GDP data, so we don't have any more real-time data for the first and second quarters. The consumer price index, you can see the acceleration as we head into the second quarter, going from about 1% to 3.5%. Net job gains, again, the contraction last year, about 896,000 jobs. And then you can see for each quarter, it gets a little better, there's less contraction. However, if you go over to the second quarter, you'll see that things tick up a bit. We have 447,000 jobs on a year-over-year basis in the second quarter, and I'll explain why this is later in the presentation. Wages paid to all workers, again, contraction due to COVID in the second quarter of last year, and then things get better, and we have very strong growth in the second quarter of this year, and again, I'll talk more about that later in the presentation. The labor force, we had a significant contraction heading into the fourth quarter, but that has improved. Our latest read for the second quarter of this year is 150,000. And then finally, the home price index, as I noted, is accelerating, and the latest read is about a 12% gain in the first quarter of this year on a year-over-year basis. So as I noted, one of the main stories, or the main story this year in terms of the economy and looking forward, is what's the impact of the federal transfers and the fact that they're going to expire shortly here and no longer be available. And on this slide, we have my office's estimate of those transfers that had flowed into the state economy. And I'll just run from top to bottom and make a few comments. So for the FPUC program, the pandemic unemployment, this is the $300 and $600 extra weekly benefits. We have that at $23.8 billion for both years. The PUA, this is for the non-traditional workers or the self-employed or the part-time workers at $10 billion. The LWA and UC extensions, this is the lost wage assistance program at $5.9 billion. The enhanced SNAP benefits at $2.3 billion. The economic impact payments, these are the 3 rounds at 32.5. The expanded child tax credit at 3.5 billion for a total of $78 billion flowing to individuals. Down below, we have the data for businesses and government entities and nonprofits. So the 2 rounds of the PPP, about 31 billion, direct state and local support at 40 billion, and other support. This is for higher education, for transit agencies at 8.3 billion for a total of about 79 billion. So all told, nearly 160 billion flowing into the state economy. That's largely run its course. And again, a big question now is what happens when this federal support is removed. On the next slide, we have the most of the same data, but we're presenting it in a quarterly payment pattern. And these are when the monies are received or dispersed by the federal government as opposed to when they're actually spent. And you can see that we have two very large quarters here. The second quarter of last year, about $43 billion. And that was due to the UC benefits, the first round of EIPs, economic impact payments from the CARES Act, and then of course the first round of the PPP at $20 billion. Then things tailed off a little, and then we had the second round of the PPP and the EIPs, and that boosted up to 32 billion. And then again, a tailing off here until really just the SNAP and the expanded child tax credit is available in the fourth quarter at $2 billion. A few miscellaneous related points to the federal stimulus down below. The research finds that about 30 to 60% of the EIPs are actually spent, and most of that is within 3 months. And if you look at our quarterly pattern above, you'll see that that's largely played out. And for that reason, as you see our sales tax forecast, we're losing strength in it. So we have 1 or 2 more strong months as people spend that last EIP, and then it starts to revert more to a normal growth rate. The data find that most of the unemployment compensation is spent, that about 75% of the non-PPP stimulus went to folks with incomes under 50,000. And then finally, a lot of these EIP payments have been used to pay down credit card debt. And for the first quarter, credit card debt was down 14%. So that's good news going forward to support consumer spending. And let me just note that for those who are interested in these data, we put out a research brief about 2 or 3 weeks ago that gives a lot more detail about the impact of these payments and how they impact the state economy. I'd like to turn to the labor market and the jobs. And here on this slide, we have 3 snapshots going back to April of 2020. And we have the year-over-year change in payroll employment. And at that time, employment contracted by about 1.1 million jobs. So this is in thousands of units. And again, this is only payroll employment, so it excludes self-employed and independent contractors. Moving forward into October, 6 months later, that figure improved to a contraction of 455,000 workers. And then the latest read for April that we have that was just released is 447,000 jobs. So you can see it appears that there's not much improvement here between these 2 points. And as I noted earlier, the forecast for April, what we're doing for that month in order to keep things on a consistent basis is we're comparing that to a no pandemic scenario. And that's noted in the footnote here. So what we're doing is we're going back to last April and we're asking the question, what would the labor market have looked like had it not been from the pandemic? And what's the jobs reduction relative to that? And of course, that includes some seasonal hiring in there. And that's how we're generating this negative 447 number. Off to the right, you'll see the associated percentage contractions. And again, not much movement here. And one reason this is concerning is that there's not much movement in the jobs. However, there's been a large amount of federal stimulus that has been injected into the economy. So that's a bit concerning as we go forward. A few details here. We have the various industries, and I'll just point out some detail on the highlighted industries. These 3 sectors comprise about 1/2 of the jobs lost for April of 2021. We have a 47,000 employment contraction for administration and waste management. And about 25,000 of those workers are temp workers. The rest are building maintenance, landscape type work. Down here on healthcare and social assistance, the 60,000, about 22,000 of those are nursing homes and residential care facilities. And then finally down on accommodation and food service, a contraction of 110,000, and about 42,000 of those are full service restaurants, and 20,000 are accommodations and travel services. I'd like to turn now to the latest read on the inflation for the state. And for that, we turn to the Philadelphia Metro Consumer Price Index. Unfortunately, this is the only measure that we have. They discontinued the Pittsburgh CPIU about 2 years ago. And let me note that the metro region also includes areas in Delaware and Newark. And so what's happening down in that metro region, of course, will not be representative of what's happening across the entire state. The latest read for the Consumer Price Index, you can see the acceleration from December and February at about 1%, and then the latest read for April at 3.5%. And then we have the various components of the index, and I haven't shown all of them here, so they don't sum to 100%. But let me just jump down to transportation here. And you can see transportation spending comprises about 14.4% of the Consumer Price Index basket. And looking across, you can see the rapid acceleration in prices for transportation. Year over year, about 13% growth. Notable is the growth in new and used cars. It went up by 11% year over year, 9% for new cars and 21% for used cars. And the rapid increase for gasoline, 36% on a year over year basis. Up above, you'll see that I have a series highlighted. This is the housing shelter component of the Consumer Price Index. And you can see that it comprises about 1/3 of the entire index. And you can see that it has very modest growth. What this number is really rent that is imputed to homeowners who own homes. It's based on a survey. And you'll see that based on the survey, the inflation here for imputed rent is about 0.6%, which when we're looking at that, we see kind of a disconnect between that measure and what we're seeing in the housing market, where housing prices are up about 12% year over year. And for that reason and some other technical factors, we think the better measure to use if we're interested in items that consumers actually purchase is this series down at the bottom. So all items less shelter, this takes out the housing component here, this imputed rent. And if we use that measure, then the inflation is about 5% on a year over year basis. So again, we think this is a little better measure of the overall basket of goods that consumers purchase. However, for the purpose of our forecast, we're forecasting this top line number because that's the one that's gets the mentioned in the press and the media. So we're out here at 3.5. But we do think the underlying inflation for consumers is somewhat higher than that. So in the next slide, we look at the impact on cash income for the state once the federal transfers are removed. And the line that you see in orange is what we call our cash income series. And it's really just all personal income that is received or realized that an individual could spend or save. So it would include wages and capital gains and Social Security and interest and dividends, any type of income that could be received or realized. And what's interesting about this is you can see for the prior two recessions, this series contracted by about 2%, the dot-com bust, the Great Recession, and how different the COVID recession will look. We have income growth of about 10%, and that is only due to the federal transfers that came into the state. For next year, we can see we have that contracting by about a little over 2%, and that is solely due to the fact that these transfers will no longer be available. And let me note that we are not forecasting a recession for next year. This is merely due to the fact that income is projected to contract, and that is solely due to the fact that these federal transfers will no longer occur. And this dynamic that you see, this drop off, it is driving a lot of what we're projecting for next fiscal year, that there's an actual income contraction in the state. So one of the things that we've noticed with the federal stimulus is there's a direct correlation between the economic impact payments that have been dispersed and what we're seeing in various consumption series. And on this slide, we look at the relationship with three series. We look at instant tickets in blue, non-motor sales tax in black, and then the orange line is motor vehicle sales tax. And what we did is we went back and we looked at the pre-COVID level in the second quarter of 2019 to get a clean read at the growth rates. And I'll just start with the blue line. You'll see that instant tickets, when the first EIP came out under the CARES Act, we had an immediate jump in sales. And then things kind of tailed off here or moderated because the EIP played itself out. They didn't have the extra payments, the $600 a week in there for all weeks. And then the third EIP hit under the American Rescue Plan, and the cumulative growth rate for instant tickets from 2 years ago is now at about 31%. For the sales tax series, we have a little different pattern. We didn't get the kick here in the second quarter because a lot of the dealerships were closed, a lot of restaurants and businesses were closed. However, in the third quarter, it showed up, and again, it moderated because of a lack of an EIP, because of a lack of extra weekly payments. But then the third EIP came out, and again, we have very strong growth for motor vehicle sales tax, 21% from 2 years ago, and for non-motor at 18%. So again, due to the lack of the EIP going forward, we think these series, the growth rates that is, will moderate, and you'll see that in our sales tax forecast. On the next slide, we take use the same format where we're looking back to the second quarter of 2019, and we look at the stock market and the housing markets. And if we make the same comparison, what we find, the black line, which is the S&P 500 index, the cumulative growth rate through this May 25th is that the index is up about 44% from 2 years ago. And you'll also notice that when the first EIP hits, this is when a lot of the activity in the S&P 500 started. For the home price index, values in the state, a bit less dramatic, and it's not as obvious that it's related to the EIPs, but the cumulative growth rate through the second quarter, we think will be at about 23%. And there's different dynamics working here for both of these. For the S&P 500, I don't doubt that a lot of firms, a lot of larger businesses came through the pandemic stronger. That is, they have larger profit margins, and the mix of their sales lends itself to higher profit margins. But also some of the inflation is starting to creep here into the asset markets, and I think both of those factors are driving this 44% gain. For home prices, it's a different set of factors. It's really a shortage of supply and the fact that the raw materials such as lumber are increasing very rapidly. That's driving these gains. As I noted, going forward, we don't think there'll be a major correction, but we do think there'll be a moderate or modest correction. We don't think these gains can hold up once the federal stimulus will be removed. So one of the questions that's arisen very frequently recently is a potential or possible labor shortage, and what do these things look like going forward? And you may know that a few governors recently have concerns about this, and they're actually turning down the extra $300 a week from the federal government over concerns that there are disincentive effects for folks looking for work and returning to the workforce. And an important question is, what does this look like for Pennsylvania? And how does it look like in the fall when these benefits are scheduled to expire? So we put together some numbers just to get a sense of what this might look like. And based on the data for April of 2021, we find that about 520,000 individuals receive some type of traditional UC payment. And ordinarily, if there wasn't a recession, that number would be about 120,000. And the difference between those two numbers is 400,000. If we look at the PUA program, roughly about 500,000 folks receive some sort of payment. So if we add these two together, the 400,000 plus the 500,000, we have 900,000 potential workers that could be looking for work in the future and re-entering the labor market. And I'll also note that that large number excludes a lot of college and high school students that are now getting out of school and now looking for work. And some of them will, of course, not return to school. They will stay in the labor force permanently. So a very large potential influx here over the summer and certainly in the fall when the benefits expire. In terms of dollar amounts, these payments that are going out right now, this translates into about $1.9 billion per month. And that's again based on April. And these payments are scheduled to expire on September 4th. And we think this will be a very dramatic impact when it occurs. For most of these individuals, they will go from receiving about $500 per week to potentially receiving no income. And the reason I'm saying that is we think that for most of these individuals, in fact, the great majority, they won't be able to find employment. So they won't have any income replacement. And there's many reasons we think that will occur. Some of them I have listed down here at the bottom of the slide. The economy is certainly operating at a higher level of efficiency and productivity. There's new spending patterns. It just requires less workers than we had previously. And overall, the trade-off here is fewer jobs, but higher wages. What we think is happening is we're seeing wage gains start to accelerate, and we think a good part of those are heading down to the lower end of the wage spectrum for individuals who are coming back into the labor market. And I'll say a few words on that later in the presentation. So let's turn now to our revised revenue estimate for the current fiscal year, and I'll just walk you through some numbers. I won't cover all of these. Our revised official estimate from January was $38.4 billion. We are adding $1.7 billion to that for a total of $40.1 billion. Now, in that $40.1 billion, of course, there are some payment shifts for delayed due dates that happened last summer, and that's about $2 billion. And if I remove that $2 billion, then we have what I call the adjusted growth rate of about 9.4% on a year-over-year basis. And you can see these adjusted growth rates are very strong. And again, these are only adjusting for delayed due dates. They're not adjusting for COVID impacts or behavior or anything like that. But we have very strong growth rates for corporate net income, motor vehicle sales tax, some PIT. Inheritance tax has been very strong. And in terms of dollar amounts, you'll see the gains are where you think they'd be. A lot of gains here. We're adding money for corporate net income, sales tax, and certainly for personal income tax. We also have gains for inheritance tax, and down here, the all other, this is the 132 million is from realty transfer and bank shares. So a fair question to ask is, well, you just did this estimate 4 months ago. Why are you adding so much money? We're adding $1.7 billion. And there is a number of reasons for that. First and foremost is when we did this estimate 4 months ago, we did not include the ARP or the American Rescue Plan or the second round of the PPP. And that injected about $25 billion immediately into the economy on a tax-free basis. So that is a very large gain once that happened, but it wasn't included in what we originally did. The second reason I'd point to is it's becoming increasingly clear that mid-sized and large businesses probably fared much better than we had originally expected. Again, as I noted, I think the profit margins are higher for many of these firms. Of course, it's a different story for many small firms, but they've engaged in a lot of activity that would increase their bottom line, such as cost-cutting measures and streamlining operations and more telework and less travel. The third effect that we didn't have an appreciation of 4 months ago was the inflation in the housing and the stock markets, or what we call wealth effects. So when your stock portfolio is doing well and your home value is doing well, you're more inclined to spend and purchase and consume. And then finally, the last factor is the stimulus-induced sales we're finding are more likely to be taxed than the normal sales, if you will, from income that you would normally receive. So we're seeing a lot of purchases of cars and appliance and home improvement projects, big ticket items that are more likely to be subject to sales tax, and we're getting an extra kick there. So let me just say a few words on our big three, and then we'll move to the forecast for next year. For personal income tax, what we're seeing in the data is that the wage growth appears to be accelerating. These data are very preliminary, and we can't assign these gains to a particular set of workers. But anecdotally, I think a lot of these gains are probably going to the lower end of the wage spectrum for folks who are now rejoining the labor force. But again, that's all supposition. I don't have hard data to back that up. Our annual payments were very strong this year. They're up 17% on a year-over-year basis. Likely causes of that, the stock market was stronger than we thought, and there's some timing of payments. And by that, I mean that a lot more money came in at the end of the year than ordinarily happens. And I think what happened here was that a lot of businesses, just like economists and revenue forecasters, were a bit surprised by how well some of the firms did moving through the pandemic. And then finally, I'd just like to remind you that there is excuse us, it keeps bumping here. There is a tax provision that's affecting both personal income tax and corporate net income tax, and that's the possible delay of the employer portion of federal payroll taxes. So that was optional if firms wanted to do it. They could push off some of the employer payroll taxes to next December and the following December. And of course, if they do that, that boosts taxable income now, it increases payments, but that will reverse later and it will push payments down. So we have that behavior built in for both personal income tax and corporate net income tax. So I had talked about wage growth accelerating based on preliminary data. And on this slide, we try to communicate what that looks like. And what we've done is we've gone back again, we skipped the COVID year and we went back to 2019. And here we have the quarterly withholding payments in billions of dollars. And back in 2019, the first quarter was about 2.8 billion. And if I jump forward to the first quarter of this year, we had 5.6% growth in withholding, but there are 400,000 fewer jobs. So that's very remarkable that the wage growth held up that well despite losing 400,000 jobs. When we go to the second quarter of this year, we find that the wage growth is accelerating. It's gone up to 6.6%. And that 1 percentage point differential doesn't sound large, but it is large. And if you took it out the whole year, it would be, of course, up to 4 times larger. But we had the same jobs loss, about 385,000. So even though the jobs contraction is about the same, the wage growth is accelerating here. And again, anecdotally, we think a lot of that is on the lower end for folks rejoining the labor force. A few notes on the sales tax. As I noted, they're responding very strongly to the EIPs. And versus last year, our non-motor sales tax is up 10.4%. That's adjusted for various shifts and transfers. However, we do have a COVID impact in there next year. And if we jump back 2 years to get a clean comparison, it's up 11.7%. So strong no matter which year you look at it. As I noted, most of the research we saw suggests that the EIP monies are spent fairly quickly within 3 months. And for that reason, we have built into our forecast one more very strong month for June, and then things start to decelerate in terms of growth because of the EIPs have largely run their course. For motor vehicle sales tax, they're up 32% on a year-over-year basis. You might recall last year in April and May, car dealerships were largely closed. And so that was pushing a lot of sales out of that year into the next year. And that's one of the reasons we get this very strong growth rate at 32%. Of course, there's other factors at work here. The federal stimulus is a big factor. Individuals who have an aversion to public transportation may have gone out and bought cars. And due to that, our forecast does include an impact from the pull forward of future sales. So the sales were very strong, but instead of buying a car maybe a year or two in the future, a lot of individuals chose to buy it this year for various reasons. And so that will be a negative impact next year. And again, note there's a price effect here. New car prices are up by 8.7%, used cars up by 21% on a year-over-year basis. Turning to our final big three, corporate net income tax. Here we have the pattern of annual receipts going back to fiscal year 12-13. And you can see back about 5 years ago, the ordinary growth rate for corporate net income tax was about 3.5% per annum. But then for the most recent 5 years, things have certainly shifted up. And over that 5-year period, we have a growth rate of about 6.5% per annum. For the current year, we have growth of 22.7% on an adjusted basis for these delayed due dates. And for next year, we have a reversal of some of that, a contraction. And there are two reasons that we have a contraction built in for 21-22. One is for the payroll tax shift that I talked about, that it's boosting revenues this year because your deductions are lower, but your deductions will be higher in future years and suppress revenues. And we also think there's some profit shifting that's pulling monies into 2021 and out of future years. And the reason for that is the administration has announced their intention to finance the infrastructure package to raise the corporate rate from 21 to 28%, as well as a minimum corporate tax. And we saw this back with the Tax Cuts and Jobs Act, where firms responded to this. They shifted income and deductions. It's all above the board, but they're just responding to the higher or lower tax rates to minimize their tax obligations. Turning to our estimate for FY 21-22, our initial estimate is about $38 billion. That is a reduction of $2.2 billion from this fiscal year, a reduction of 5.4%. However, if we control for the various shifting due to delayed due dates, it's really an adjusted growth of 0.7%. And you'll see some rather large reductions here in corporate net income, a reduction of 5.6% on an adjusted basis. And again, the reason for that is the payroll tax shift and the income shifting that we think is occurring. Down here in motor vehicle sales tax, contraction of 8.7%, again, due to the factors I noted, the lack of stimulus, the pull forward of car sales. These are growing at about normal rates. And the only other thing I'll point out is for all non-tax, you'll see it's falling by $538 million. And that's due to some transfers that were received earlier this year that are not received next year. So I'd like to close the presentation with two slides here and just bring home the point of how different this recession was than prior recessions. Because what we think will happen in this recession is that the economy is going to return to its former growth path and not downshift. So it's as if nothing occurred, at least in terms of general fund revenues. And at the top half of this slide, we have our general fund tax revenues before COVID for 18-19. And then we have our forecast for 21 and 22. And to the far right, we have the average growth rate between those 2 years. So you can see going from these 2 points, these are average growth rates as if no pandemic had occurred or no federal stimulus. And we were just operating on normal everyday growth rates that you would expect under normal circumstances, running about 3%, sales and use tax a little strong at 3.9%, but very ordinary growth rates. Down for the economics here, for real gross domestic product and wages paid, it's a similar story. Gross domestic product is a little weaker than we ordinarily observe. This is usually about 1.5%, but the wage growth is about the same. The main difference here in our projections is the number of jobs. So we will think, based on our forecast, that there will be about 258,000 fewer payroll jobs for calendar year 2022 versus calendar year 2019. So with that, I'm going to conclude and just note that there's 3 issues that we think are very critical going forward. First and foremost is what the Federal Reserve will do, and they're going to pay close attention to the next release of the Consumer Price Index and the PCE index that they pay close attention to, that's personal consumption expenditures. That data point will come out for April, I believe, this Friday. And the question is, if they see another strong inflation reading, what will they do? Will they accommodate it, or will they signal higher interest rates? Another important question is what happens to the housing and stock markets? Is there a major correction? That is possible. There's a number of things that could cause it. As I noted, we've assumed a modest correction in our data, both for the stock market and the housing market. And then finally, the last key issue that we talked about today is what's the impact from the surplus labor and how many of these folks attempt to re-enter the labor force either this summer or fall. And moreover, do the wage gains that we think are occurring right now on the lower end, do they hold up? It's possible that the folks who are coming back into the labor market in the fall, they might have to take a lower wage rate than the folks who stayed on or are currently working. There could be a 2-tiered wage structure for folks working through the pandemic versus those attempting to return, because as we saw, there's a very large amount of potential labor that could be entering this summer and fall. And with that, I will conclude the presentation. I'll note again that both of these, if they're not out there now, they should be available very shortly. And what I will do is turn to the chat feature and attempt to answer any questions. So I'm just going to pop out there now. And I will just read them aloud and try to answer. And if you have a question later that you weren't able to ask or occurred to you after the presentation, please just send it to the contact box and we will get back to you today. So we have a question, and I'll just read it aloud. With billions in ARP dollars still to be spent by state and local government, doesn't that have the potential to juice the state's economy through at least a portion of 21-22, with the possibility of improving the forecast for 21-22? And I would agree with that. I think that potential is there. I would say that's going to hold up the spending at a level that we would have expected. And therefore, on the spend side of the budget, things are, roughly as they would have been as if there hadn't been a pandemic. It's just providing that additional support. It may be a little stronger than that, but that impact generally is not as strong as a direct transfer to an individual. So I'd agree there's some potential there. How large it is, we haven't investigated it, but we will definitely keep an eye on that going forward, because as noted, these monies can be spent over the next few years for designated purposes. Another one question is, I don't understand the wage gains because there is a backslide on the $15 an hour. And so this, I'll try to answer it. So we talked about wage gains, and we think that a lot of them are likely going to the lower end because that's where the demand is for the jobs, for the leisure and hospitality and warehousing and delivery. Again, I don't have hard data yet to point to. This is all anecdotal. That data really won't be available for a year or two to say what workers are benefiting from these wage gains. The only thing we can say right now is it does appear that wage growth is accelerating, and the individuals who are being added to the labor force are generally usually at the lower end of the wage spectrum. So we surmise that they're likely the ones benefiting at this course. And you've seen anecdotally, a lot of firms have announced that they're raising their wages. Bank of America, Amazon, I think Walmart came out a bit ago to say these larger firms that they're raising them up. Next question is on inflation. Can you explain the difference between the consumer price index and the producer price impact, which I think shows in highest inflation, and who is impacted by the latter? Yes, my recollection is the producer price impact showed higher gains to the producers and the raw material suppliers. So that's on what I would say that's on the front end of the supply chain, whereas the CPI is on the back end. So one would think that the amounts on the front end would eventually translate to the back end. That doesn't always happen. Sometimes it's absorbed along the way, that firms or retailers cannot pass along these price increases. But yes, I agree. The producer price index is higher. And again, I would reiterate that for the consumer price index, our preferred measure is to look at the one without shelter, which is now running at about 5% for April, because it removes that imputed rent for existing homeowners. Next question. There's been a lot of anecdotal press coverage on strained supply chains and resultant inflation, correct? Does IFO project any Fed interest rate intervention in 21? I would say we did not make an explicit forecast for whether they will or they will not increase interest rates or the impact that would have. What I can say is that in those two markets, both in the housing market and in the stock market, we don't think those gains will hold up. I'll give you an example. I think the stock market for this year, since the end of last year, it's up maybe 30%, but we only have capital gains in our personal income tax forecast going up by about 10%, 8 to 10%. So we do think once the federal stimulus is removed, that the economy will slow down some, and those gains in the stock market won't stick. For the housing market, yes, if the Fed started raising the interest rates or started to tick them up, we think that will directly flow through to the mortgage rates, and it would eventually impact the housing market. Realty transfer tax has been very strong this year. For next year, we have flat growth in the realty transfer tax revenues. So we do think there will be some slowdown in the price appreciation. What's really the factor here is the lack of supply. And it takes a while for those, for of course, the housing to get into the pipeline, get built. And I'm just checking to see if there's any more. And I'll just wait a minute in case anybody else has any. Okay, let me just one final word because I did not cover it during the presentation. As you might be aware, the final payment for Pennsylvania was delayed until May 17th. And I will say that that payment was considerably stronger than we would have thought going into it. We think we've seen all the payments now, but what that suggests to us is that overall, the 2020 calendar year was generally better for businesses that we had assumed previously. And one of the reasons we're receiving more monies now is I think businesses had assumed that as well, that it was going to be a very bad year. But when all was said and done, largely due to the federal stimulus, things have held up much better than we had anticipated. So with that, I want to thank everybody again. And again, if you have any questions, please send them to the contact box and we will get back to you today. And the report and presentation should be posted. Thank you, everyone.